Good afternoon, everybody. I'm going to start straight away on slide 3 and give you an overview of the first half results and some of the progress made therein. And then I'll hand over to John and he'll take you through the segment view of the financials. So at a headline level, adjusted PBT came in at 3.4 million in the first half, which was 4% up on the equivalent period last year and in line with our expectations. Underlying that, the real story is that diversified activities have continued to represent an increasing proportion of our income streams and now stand at 52% compared to the comparator of 44% in the same period. During the period, we've been undertaking a series of investments to ensure that we inject some growth into the business on an ongoing basis, and we've invested 9.6 million pounds in investments in acquisitions and associated exceptionals. That's increased our net debt position to 7.1 million from a cash position of 2.8 million. But as you'll see, as we describe later on, they represent investments which will be earnings enhancing and start to give us some flow into the second half of the year, particularly giving us growth on the revenue line in the second half. So when we spoke last time, we identified 4 key areas of focus with the business, and the table on page 3 gives you an update on the progress we've made on each of those. The cost leadership area is the activity and strategy we've taken on our core business, where we've looked to reduce our operational costs in order to ensure that we can improve margins. We made great progress in the first half on this, with margins on IVA up to 19% of revenues from 15% in the preceding period. The decision we've made in this segment is to ensure that we're being very selective in where we're spending our marketing monies whilst the market remains challenging. And instead, we're broadly investing in some other areas which we think will be better value than marketing activity for IVA. The first of those is acquisitions of back books. You'll be aware that we've undertaken a number of acquisitions over the last few years of back books. We're very familiar with the process to buy, value and manage these and integrate them. And in the first half of this year, the activity level has stepped up, and we've undertaken a number of these acquisitions which have boosted all measures in this segment, and John will give you a bit more detail on those later. But the headline is that our case count has increased to over 20,000 from over 15,000 in the equivalent period. The claims management segment mainly consists of PPI mis-selling claims, and in the past has mainly comprised of PPI mis-selling claims to IVA customers. What we've been doing in terms of developing this segment is also making those claims on behalf of our debt management customers. That latter area is in growth whilst the IVA PPI claims matures, and we expect that the Rightfully Yours PPI, which is cross-selling PPI to debt management customers, will pick up a pace as we come through the second half of the year and start to regenerate the momentum in this segment, whilst we also continue to undertake further development activity. That development activity in turn will be accelerated as we start to bring together the expertise of Simpson Miller, which is our legal platform and acquisition, which also undertakes a good amount of activity in the claims field. Talking of Simpson Miller, when we spoke last time, we talked about the core competency within the business of industrializing professional services and the ability to take that to the legal services marketplace. We've made great progress there through the acquisition of Simpson Miller. It only contributed for 2 weeks of the first half of the year, so most of the results from Simpson Miller and the benefits therein will arise in half 2. But it's got off to a great start. Simpson Miller itself has undertaken some acquisition activity, both prior to acquisition and after the acquisition, and we have integration work streams and activities underway in order to make sure that we see great value coming from that acquisition. So to take you through the financials and some of the segment views, I'm going to pass over to John Gittins.
Thanks, Chris. And if I could start on slide 5 and take you through some of the headlines from the income statement. As Chris said, sales overall were flat in the first half, so really strong growth in our DMP segment and a first-time contribution from legal services was offset by reductions in IVA and claims management. But through very tight cost control, our adjusted pre-tax profit was up 4% to 3.4 million. And the adjustments we make to that measure is to back out amortization of acquired intangible assets of 1.1 million and exceptional acquisition and refinance costs of 1.2 million. Our EPS, adjusted EBS basic, was 6.2 pence per share, which is up 6%, and we've declared an interim dividend up 7% to 2.3p. Moving now to the bridges, and first of all, page 6, the revenue bridge. You'll notice that there are a number of moving parts to the revenue bridge, and visually you can see that the growth in DMP and legal services is almost exactly matched by the reductions in IVA and claims. And if we turn on page 7 to the profit bridge, all but one of our segments grew its bottom line result, and that was claims management, which we'll go into a bit more detail in a second. So turning to the detailed segment view, first of all, revenues on page 8, moving from left to right. As Chris said, our IVA activity has been challenging, and revenues fell by 14% to 7.4 million. New cases under management during the period were about 1,500, and that was a 33% reduction. And this period has really all been about case selection and being very, very disciplined in the work we take on. So pleasingly, in tough conditions, we've been able to increase the average gross fee for each new case to nearly 3,500. That's up from 3,100 last time around. The overall book is just under 19,000 customers, which is a reduction of about 8%. Moving to DMP, a 45% increase in revenues in DMP segment, driven by the 35% increase in cases under management. And do note that we've acquired a further 9,000 cases since the half-year end through the acquisition of Deadline. So that bodes very well for the second half. For claims management, revenues fell by 1.3 million to 2.1 million. As Chris said, sales to existing IVA clients are reaching maturity, and that's not being matched by our growth in PPI and other product sales to our ever-growing DMP clients. But as you'll have just heard, we are growing the DMP book. It's now 21,000 or so cases under management, and we expect that to deliver further growth in claims management in future. And finally, legal services, we acquired Simpson Miller on the 16th of June, so just 2 weeks of revenue contribution from that new acquisition, but that nevertheless delivered an important 1.2 million of revenues in this half. Turning to page 9 and the profit contribution by segment, despite the fall of 1.2 million in revenues in IVA through very tight cost control, particularly in our marketing spend and direct costs, we're able to deliver an uptick in profit to 1.3 million. For DMPs, we've increased profitability by 58%, and really the increase in case volume has been able to allowed us to realize the economies of scale. In claims management, inevitably the top line reduction has had a bottom line impact, and we posted a profit of 0.6 million in the period. And finally, in legal services, a good first-time profit contribution of £120,000 for the 2 weeks under our ownership in this period. On page 10, just another indication of our operational efficiency and our discipline, particularly in marketing spend, which fell from just under 18% of turnover last year to 13.5% this time round. And overall, direct costs as a percentage of revenues have fallen from 49.1% last time to 48% this year. Moving to the balance sheet on page 11, a lot of moving parts to the balance sheet compared to the start of the period. And this is all explained largely by the acquisition of Simpson Miller. So on this slide, on the right-hand side, we've just indicated the balances that we acquired as part of the total makeup of the 12.7 million consideration for Simpson Miller. Now that deal was funded, the initial consideration was funded as to 5.7 million in cash and 2 million in new shares. And we've recognised a contingent consideration liability of 5.1 million on the balance sheet. The deal establishes contingent consideration in total of 6 million, and that will be dependent on the financial performance of Simpson Miller over the 2 years ending June 2016, and payable 50% in cash and 50% in new shares. Turning to cash flow on page 12. Operating cash flows have fallen from 3.8 million to 1 million. However, a number of exceptional once-off items to draw to your attention. There were outflows of 0.7 million associated with the exceptional costs we incurred in the period, and first-time working capital outflows of 1.2 million from relating to Simpson Miller, and largely due to VAT payments and payroll at the end of the month, which won't be repeated. And finally, an increase in tax payments in operating cash flows of £500,000 due to previous years, including reclaim from a number of previous years before that. This has been a period of significant investment in the future of the business. 8.9 million spent on acquisitions in the first half, of which a net 5 million spent on Simpson Miller and 3.9 million on 2 DMP transactions. And finally, in financing, the big feature of the cash flow is the refinancing of the old PNC facility with AIB, which is a good lead into slide 13, which describes both our cash and net debt position and also the banking facility. So this was a facility for £20 million. It's a 5-year committed line with Allied Irish Bank, and it comprises a 12 million revolving facility and an 8 million term loan. 5 million of the 8 million term loan will be repaid during the 5-year period, and 3 million repayable right at the end. It replaces the £13 million PNC facility, which was due to expire in April 2016. And we incurred in that refi £500,000 of once-off professional and other charges. So the position on debt at the half-year end was 7.1 million of debt, and as of today, bringing that up to date, we are about 8.4 million in net debt, which is a strong result considering that since the year end we've spent 3 million on the debt line acquisition. Finally, some financial trends for the second half of 2014 on page 14. In terms of the segment trends, we expect the thematics for us to be a concentration on efficiency and margin maintenance, as we don't anticipate any change in the challenging market conditions. The DMP segment is expected to continue very strong growth, particularly with the acquisition of debt line that we completed in August. Claims management activities will continue to be an important contributor both to revenue and profit, and we'll have a full second half impact from the legal services acquisition of Simpson Miller. We expect tax rate for the full year to be somewhere between 21 and 22%. We pay an interim dividend of £1 million in October, and as I've said earlier, we acquired debt line for £3 million in August, and that will attract 0.2 million of transaction costs and 1.1 million of restructure costs. So now I'll hand back over to Chris.
Okay, well, I'm going to turn you to page 16, and the purpose of slide 16 is to take you through what we think is the start of a new chapter within FAIRPOINT Group, reflecting the acquisition of the legal services business Simpson Miller. What we've done on this slide really is for the IVA, debt management and claims management segments, we've taken those numbers as they apply to the full year 2013, And then we've pulled out the annual turnover from the legal services division in its most recent 12-month period, which runs from June to June. What this chart shows you, therefore, is that the natural size of the group, all things being equal, would have been 45.2 million on a pro forma basis, and then that equates to a turnover in 13 of about 28 million. So you can see that the addition of the group makes a sizable new contribution in terms of revenue to the products and services that we offer, and helps us achieve our objective of the continuing diversity of income streams within the group. On page 17, we lay out the new mission of the enlarged group, which has been changed from the previous mission statement of making money go further, which is still relevant and applies to our debt business, but doesn't have such a good fit with our legal business. We've replaced that with the phrase pointing you towards better solutions, because essentially across all the business units in FAIRPOINT Group, our objective is to listen to consumers, collect data, and provide advice, the result of which points consumers towards better solutions which improve their position. And the way we're going to deliver on that is through the 4 themes that are outlined below. And I'm going to turn you to page 18 and start with the opportunities with developing the consumer franchise. Obviously, within the legal services business and the debt business, we have 2 customer segments which we're bringing together, because those segments and the way we talk to our consumers offer opportunity now across the group rather than just in each individual business unit. To give you an example of what I mean, in the debt side of the business, we generally start our conversations with consumers with a set of questioning around how they got into the financial difficulty that they're in. And that's really about trying to generate some rapport and empathy with the consumer. But of course, during that conversation, the consumer will point to things such as relationship breakdowns, losing their job, and so forth, often which give rise to legal services. So going forward, we'll be able to capture some data from those conversations and ensure that the broader opportunities from a solution point of view, which are available across the group, are introduced to consumers. And obviously that will work the other way around, where we find that we're in dialogue on the legal side. We'll also be identifying consumers who are indebted and could do some support on the debt side. So we think from a group perspective, there's a synergy benefit to come from developing that consumer franchise on a group-wide basis. On page 19, we have the real rationale as to where we think we can generate a competitive advantage which is structural in this marketplace. And we describe it as leveraging process and expertise. And the way I would describe this is that in the FAIRPOINT Group, and in particular in our insolvency business, we have a core competency which is about putting a process into a professional service. And what we do there really is we have 4 licensed insolvency practitioners who are responsible for the onboarding and the supervision of each case individually. However, those 4 individuals manage 20,000 cases or thereabouts because they have a system, they set the business rules, they have exception reporting, and they're able to manage and if we look at legal work, that ought to be able to benefit from the same approach. So a lot of legal work is very administrative in nature and could use a process put around it. And by applying that process, we can lower the costs and we can generate certainty as to how long and how much is going to be involved cost-wise in performing a job. And by doing that, we can then convert that into propositions to consumers which start to offer better value. Now that will be particularly important in some of the simpler legal products like wills, conveyancing, personal injury, in the same way as it's important in the debt management and the IVA market. But obviously it's not instead of the legal expertise that we still want lawyers to apply, but where it's relevant. And areas such as clinical negligence, which will have a much higher weighting on legal expertise than, for example, constructing a will, and therefore will benefit less from process, but that's because those kind of bits of work are dependent on the results of cases, because the fees tend to be contingent or conditional on the outcome of a case. On page 20, we outline the third strategic theme, which is one we've been using substantially in our debt management business, where we've been growing through consolidation by acquiring back books of debt management cases, integrating them into our operating platform, and then running those cases at lower cost than the company we purchased them from. As we've outlined, we've purchased 3 of these transactions in the first half of this year, and they've generally been able to contribute for about half of that period. In addition to that, we made another acquisition in August, which will also give us further earnings growth into the second half of the year. The same model that we apply for the purchase of back books is also a model which Simpson Miller, our legal business, have been using to acquire work in progress of legal cases. And so we'll be undertaking a very similar activity in that market sector, which will help boost growth. The common skills we have been able to value and then integrate these cases and manage the workloads. It prepares us well to take advantage of the opportunities in both marketplaces. So to give you a bit more detail on the Simpson Miller business, we call page 21 Building Our Legal Platform, because we see Simpson Miller as the legal platform for the group, which we want to develop and build upon. And the first thing we need to do in this section really is just to give you an understanding of the market dynamic in the legal services marketplace and why we think we can develop in this area. So the legal services marketplace on slide 22 is highly fragmented. There are over 10,000 legal firms in the UK, but it's a large market, £27 billion worth of industry revenue, around about half of which is consumer legal services, which is essentially the main part of the Simpson Miller business. The way the products are offered to consumers is that consumers pay for time, and as I've said earlier, most of the time they're buying is the time that they pay for a lawyer to be involved in their workload. Our hypothesis is that we can reduce that time by taking administration and routine tasks away from lawyers, allowing them to concentrate on the legal expertise and therefore lower costs and increase margins, whilst providing a more consistent service to consumers. Simpson Miller is our chosen platform, and on page 23 we outline some of the credentials of Simpson Miller, which we think make this business ideally placed to be able to take advantage of that market opportunity. Simpson Miller has already made some significant steps in the generation of an application of process into legal services, and in particular has done that through securing an award called Lexcel. Now, Lexcel is an accreditation status run by the Law Society, and in order to achieve that accreditation, you have to demonstrate the application of process and case management in the way you run your practice. And that's the bedrock of being able to create this competitive advantage I've described. On page 24, we outline a bit more detail of the track record of Simpson Miller, but I think the key points to bring out are they have made progress on the process side, and they are already skilled in acquiring legal services work in progress books and integrating them. And those two ingredients are going to be important as we look to deploy the integration program and develop the business further. And on page 25, we outline those integration opportunities. And you'll see that the integration opportunities very much map back to the strategic themes that we have across the group. The fourth row here, I'll take first, of strategic theme, really is the kind of bread and butter of any integration program. You'd anticipate that as we bring two organizations together, we'll be able to leverage buying power. There'll be some organization design changes, which are mainly around avoiding duplicating some functions like finance, HR, and IT, where we think there's commonality and they should be operated on a shared services basis. The other themes, however, are about bringing to life the general strategic agenda that I've described to you earlier. So developing the consumer franchise I covered off earlier. It's about making sure that where we have a touch point with the consumer, we're able to bring that advantage to all parts of our business. Partnership distribution is a key feature of Simpson Miller, where they distribute through, for example, unions, and we'll look to bring the broad range of products available in the group now through those distribution channels. From a process and expertise point of view, we've got a few areas that we're focusing process changes on in the early stages of the acquisition. I'll pull out one of them as an example, which I describe here as re-engineering the sales process. And what I mean by that is that in our debt business, we spend quite a bit of time in our contact center trying to understand the customer's circumstances and situation, put that data into a decision rules-driven system, and then come up with a provisional outcome and bit of advice for the consumer. And at that point, if the customer wants to proceed, we then pass the case to our insolvency practitioners. In the legal world, it's typical that that conversation will occur with the lawyer rather than through a decision-supported system and using contact center staff. And obviously, applying legal resource to work that might not result in a case can be expensive. We think if we deploy the debt model to the legal world, we'll see a significant reduction in our cost base and also a better quality of work for the lawyers to be able to progress with. The growth through consolidation I described earlier, and as I say, in the legal business we have a number of acquisition targets, some progress made already this year, and a further acquisition since we acquired Simpson Miller of a family legal practice, which is helping us continue the momentum in that area. On page 27, I provide a summary and outlook. I think the key thing that I bring out here is that the first half results are in line with expectations. The revenue's flat, but there's a small growth in profit. But what it doesn't really bring out is the sheer quantity of work that's been undertaken on the acquisition agenda. Most of those acquisitions are now fully integrated, particularly on the back book of debt management plans, where all of the acquisitions in half one are now on a single platform in a single location in one call center and one system. The income streams and associated profit from those acquisitions will therefore follow in the second half of this year and give us a material increase in revenue. And the confidence in the outlook from there has allowed us to continue increasing our dividend. So from an outlook point of view, as we look to the second half and beyond, we're delivering on the strategy, our diversification agenda is gathering pace, and the acquisitions that we've made in the first half will be accretive to the second half. And our cash generation, even since the period has ended, despite a £3 million further investment in an acquisition, leaves us in an increase in debt position since the half-year point of only 1.3 million. So hopefully that gives you an update on first half results, and I think we move over to some questions now.
Yes, thank you very much, gentlemen. Very clear. Can I remind you to submit your questions via the internet? We have a number already, quite a lot relating to Simpson Miller, which is obviously a very exciting area. First one is from Jeff. Simpson Miller is stated as having grown its revenues by over 40% from 2009 to 2013. Do you know if all of that growth was achieved organically, or whether they have significant acquisition experience as well?
So the answer to that question is a combination, but the acquisition activity that's been undertaken has been relatively low level but consistent. So in other words, smaller practices being added to the business rather than it being the substantive component. So a combination of organic and acquisition. We'd expect the two of those elements to play a continuing feature in the business as we look forward.
Okay, and also in terms of expanding the legal franchise geographically, is that feasible to do by opening up in new locations themselves, i.e. organically, rather than just acquiring existing firms?
It is feasible. Our model really is to move from a model which has geographic diversity with a range of functions being performed in each area into one which is more of a hub and spoke model. So the nature of legal services is that a local presence is often quite important as a way of winning business and generating local market reputations from lawyers, and that will continue. It will probably be most effectively achieved from a growth point of view through some acquisition. But for us, it's not the be-all and end-all, because we do have coverage across 12 major areas across the UK, and part of our agenda will be looking at our back office and centralising some of that to create centres of expertise.
Okay, thank you. Then last one from Jeff, showing his age here. He can recall Tenon, which was also a consolidator but in the accountancy sector, and went on a debt-financed acquisition spree that ended up with itself being in administration. So he is naturally a little wary about rapid growth via acquisition. What comfort can you give him that this time it will be different?
Well, I think that the first thing we will be is disciplined, and you'll have heard in the update that we have a new facility of 20 million, of which, as of today, we're using 8.4 million. The approach the board has taken is to borrow to a sensible level to invest in the future of the group, as Chris has just outlined. And we are going to target something in the region of 1 times EBITDA as a target level of debt. It may go slightly over that at various periods of time depending on deals, but we will be very, very disciplined in terms of use of facility and the level of leverage we'll go to. The second point I'd like to make is really just to draw on our experience, both ours and the new team we've acquired at Simpson Miller. We have done 16 deals in DMP over the last 4 years, and all of them have achieved our targets and have been integrated extremely successfully. So we have great expertise in both choice of deals and integration. And similarly, Simpson Miller themselves have done 6 acquisitions in the legal services sector over the last 3 or 4 years, 2 of which have been this calendar year. And our view is they are very skilled and experienced in that skill. So a combination of both of our skills, we believe we'll be both disciplined and careful in terms of selection and integration.
And I think finally, just to add to that, the other important characteristic is the way we go about valuing these businesses, in that essentially what we have paid and based our price on for Simpson Miller and will for other legal businesses is taking a view on the work in progress, discounting that for cases that won't come to the end, and also the cost of working that work in progress through. And effectively the prices we're paying are based on that work in progress as it stands at the point of entry, as opposed to a forward projection. So the downside risk on the acquisitions we're making from a valuation perspective is very low. The upside obviously is that we expect that work in progress will be added to because the businesses we're buying are going concerns.
Okay, thank you very much. And again, just moving on, still Simpson Miller. Do you think that age of partners in smaller groups might be a propitious target, given that retirement is potentially looming or attractive for that generation of post-war baby boomers?
I think what we see is that will be a factor for some legal companies and acquisition targets and so forth coming through. There are a number of other features in the market that are likely to drive consolidation, however. One of those is that there is an increase, has been for a little while, in the costs and access to professional indemnity cover. And that is causing a number of partners to come out of the market or need to come out of the market. In some cases that does have a correlation with age, but not always. And the other factor is that there is an increasing amount of movement and momentum for change in the legal marketplace as a consequence of the regulatory changes that have occurred in terms of an increasing amount of fixed cost recovery work and the like, which are causing legal practices to need to operate on more of a process basis. And that's not the easiest job in the world to do if you're subscale.
Thank you. Just in terms of shareholders who have benefited from extremely good dividend flow, do you have a formal policy of dividend growth and indeed dividend cover?
No, I think as we stated in our release, dividend policy is a function of opportunities to invest, it's a function of the profitability, operating cash flows and so forth. But we're entirely comfortable with the level we've got at the moment. We're comfortable enough to increase the dividend during this period, and based on what we can see at the moment, we're very comfortable with the dividend levels that we have proposed.
Thank you. In terms of acquisitions of back books, Brian is curious, when you make a purchase, obviously part of the strategy is to share cost with existing administration that is centralized, but do you retain any sales or marketing staff?
Very rarely. So really from a debt management perspective, the vast majority of the acquisitions, there are hardly any exceptions to this, are all based around buying a back book and valuing that back book. Most of the transactions we make, we don't actually buy the company, we just buy those assets. There are a couple of exceptions, including the most recent one of Deadline, but the approach on that business, again, is to treat it as a back book acquisition and integrate it into our business. Clearly, we do have brands that we take on there, and we do take new business from them, but it's not something that we're particularly valuing or have as a core part of our acquisition strategy.
Thank you. Just a couple more questions. A technical one: is there a lockup on the partners holding consideration stock from the?
There is. They're locked in for 2 years, which is the period of the earn-out. So the lockup is to June 2016.
Okay, thank you. Then I think just time for the last one. Intriguingly, on an area where you're not active, Jim says, credit where credit's due, you have successfully and correctly avoided payday loans as an area of focus in the last year or two. Is that policy likely to change, or are you in effect waiting for efficient regulation of this business sector before looking again?
No, we've no plans to consider payday loans again.
Okay. Well, I'd like to thank Chris and John for the presentation, and of course for the audience participation. In terms of forward-looking estimates on earnings, revenues, and indeed dividends, Equity Development did publish its analysis of the notes via a note on the results yesterday, so that is available. And I'd like to wish everybody a very happy weekend.